Oh boy, very glary. Sorry about that, folks. Good afternoon. My name is Kristina Kuprina. And for those of you who may be watching this for your first time, I am the client portfolio manager and chief economist of Sequoia Wealth Advisors. And we do approximately every month and kind of an update on the economy, what's going on, answer questions that were sent in advance. The intention behind this is just to be able to give a place to get information without necessarily narratives or bias and the rest of it, and also to get your questions answered. It is really hot and humid here, so sorry, I'm all shiny and whatnot. Less important, the way I look is the information that I will share today. I wanted just a couple housekeeping items. As you may have heard from recent webinars, the regulators have said we can no longer use the Q&A function on the webinars. So any questions you have, Caitlin is standing by. Just send them to the Connected Sequoia email that you got the invitation from. And I will be checking in with her for any questions that were not sent in advance. And in the future, you can always send questions in advance, and I will put them in and bring them as part of this presentation. As well as if your questions don't get answered today, you're welcome to send me an email. Happy to chat with you about individual questions, maybe things you don't want to share in a public forum, and or things that come up later. So this is the whole intention of this, again, is getting the information to you that you find the most valuable and having it on a somewhat regular basis. So that being said, there's a lot going on in the world. Probably don't need to tell you that. Almost it seems like every time in recent months I've been doing this, there's a lot going on in the world. So what I would like to do is to be able to answer the questions that you have and you sent in advance, and also kind of give you some updates on what's happening. And I did call this sort of a mid-year outlook, only from the standpoint as we are now halfway through the year. However, we have just begun earnings season, so I really feel like by the next webinar, this could be slightly different. The other thing I'm going to do a little different this time is I've had a lot of requests for sharing charts and sharing information and not just me talking the whole time. It's a little challenging to me because I like to be present when I speak, and I find jumping back and forth between screens makes it a little more difficult. So how I'm going to do it is I'm going to go over a few charts in the beginning, and I can pull them back up if needed with questions and whatnot. But that being said, that way I can also get to the rest of the questions and the topics. So the most popular topics, of course, about the war, how that may impact the economy, and on again, off again situation. A lot about AI, data centers, that's been a big one. Are we in a bubble, the markets, the economy, and things like that, and expectation for the second half of the year. So all of those questions will be answered. But I'll start off with the charts from the standpoint of the question has been, how's the economy doing? How's it really doing? The challenge that we have often is that we do have a lot of different information coming from the media. A lot of times there's a political narrative, there's a social narrative, there's more behind it. And with economic data, and any data really, it's very easy to cherry pick pieces of information to support a narrative or a belief, which is fine. However, that makes it really difficult sometimes for people to understand what is really happening. So the charts that I share are all going to be from official sources. It's going to be from the Bureau of Labor Statistics, from the Federal Reserve. It's going to be from sources outside there. None of these charts were created by me. And the reason is I want you to be able to also yourself go and look it up and be able to get information if you feel that you want more. But the big question that comes a lot is if you listen to the news day to day, it feels like that the world is really crazy. And in some ways it is. So the economy is not politics, and the economy is not the news. The economy runs on a few different pieces of information primarily, and sometimes certain pieces of information become more important to the direction of the economy than other. Anytime you have a political change or change in leadership, then you can also have a little bit more uncertainty around that. And that's what we will probably experience as we head into the midterms, right? How the midterms play out. I will also let you know that on our October 6th webinar, we will have Bob Stein out again. He is the chief economist he's out in Washington, and he is the political geek and expert. And we'll talk a little bit about the midterms, probabilities, how things may look. Obviously, there's no certainty there, but it gives the people who have more of the political ideas or want that kind of the political aspect of what's happening with the midterms. Usually have him speak every election cycle if I can get him, because he's very popular, and he does a lot of media shows as well. But I just want to let you know, save the date if you want more of the political and the midterm kind of viewpoint, economically as well as politically. That being said, so start with a couple of charts here. And again, questions come up, just send them over to Caitlin and we'll go from there. Now, these charts were uploaded yesterday and one this morning. I was trying to get the updated CPI this morning, but I started my day at 6 and it hadn't been put into the systems yet. So I'll have to talk about that one, which is consumer price index. So inflation is a big question. You're hearing a lot of news information about it. I've talked in the past a little bit about the cause of inflation, why inflation was higher. I'll just touch upon it briefly. Massive government spending, a massive amount of money pumped into the system during the pandemic, created a big spike. You can see that here in inflation. It's come down significantly since then. This little jump you see here, that was when the war started. And the cost of oil and gas was the entire driver of this. The most recent report, it's back down to in the threes. However, the war again is reignited. So we'll have to see where that plays out. Why I'm showing the chart is primarily just to see historical norms. We'll take out the 1970s when we had really, really high inflation, and just looking at recent times, you can see the volatility within it. Energy is one factor, and oftentimes we look at two pieces of inflation data. One is the core CPI, which excludes food and energy because they tend to be more volatile. And the other one is total CPI. This is total CPI. The reality is that is what hits the pocketbook, right? So it is more, but the reason for looking at core without these two is to see if there's a trend, underlying trend, higher or lower. So just to give you an idea, again, this is before today's print, which is lower, but this number is probably going to be moving about a bit. I will touch upon something about that's important, is that when the war started, oil prices spiked over $100 a barrel, and they came back down into the 60s, like high 50s at some point, and now they're back up again, just in the high 70s today. As you notice, even though the war is reignited, we haven't had the same jump, and that is because supply chains have moved, right? Initially, you have to think of a tanker, right? It takes a long time to get from point A to point B. There's contracts, there's arrangements where oil is purchased, so they can't just snap their fingers and change when there's a regional conflict. Since then, because the whole area has been continued to be unstable, more and more countries are looking at other sources. And you see, like, for example, in the Gulf of the United States, it's packed full of ships, right? So people are looking at South America, looking at Asia, they're looking at the United States, looking at other sources. And so that's why even when the disruption picks up, it usually has diminishing effects over time. And we have this from multiple conflicts in the Middle East to be able to see that. Gone are the days of the 70s where it all came from one spot. Look at the Suez Canal is another example of when there was a big conflict there, the impact, and then things started to diversify. So the effects of the war on oil and energy prices will likely diminish over time, provided that it remains it doesn't become a big regional. A lot of other countries get involved, things become messier and messier. Highly unlikely at this point, but it's anybody's bet how this will play out. Anybody's guess, sorry, how this will play out. The other one I want to share with you is consumer spending. Again, what drives the economy? 2/3 of the US economy is consumer spending. It is a really big, it's amazing to see how resilient the consumer collectively has been with everything that's been happening, right? The consumer continues to spend. The difference between these two here is retail sales opposed to everything else like services that people are spending on. So as you see, again, you get the historical norm over this period of time. Disregard this. This is the COVID craziness. All data got really kind of distorted during that period of time. But as you can see, the consumer spending has been holding up. And a lot of that has to be with low unemployment numbers and what I call the wealth effect of what's happening with asset prices that drives it. So 2/3 roughly of Americans own assets, and assets have appreciated. So even if they're not spending this money, even if it's long-term retirement money, it still makes people feel more comfortable in their spending. So this is the driver of the economy. And I like to show that because sometimes I talk about it to be able to see it in a chart form is helpful. A lot of these I'm going to be pretty quick on. This is the other big one. Hear a lot in the news about how debt levels are growing and Americans are struggling. Yes, the bottom third of the socioeconomic scale is struggling greatly. You may have heard the term K-shaped economy. I'll define it for those who haven't heard it, but imagine the letter K. So the middle class and the upper class, those who own assets, have experienced a more different economic picture. than people on the lower end that don't own assets. The reason being is rising costs of everything. For those in California, your PG&E bill, your homeowner's insurance, your cost of housing, your cost of everything is rising rapidly. If you have assets or income increase to keep up with this, it's not as much of an issue. But for those who don't, they're absolutely getting crushed with rising costs. This is not just inflation. This is not just oil and gas and the war and all the rest of that. That's a cost of everything. And these are essentials, which is nothing. It's a necessity thing. Many of you know that we're big supporters of the food bank, and the demand has skyrocketed. There's a demand skyrocketed all around the cost of living and inflation. So this is a really, really big issue. So do understand this is a national number. There are segments of the economy having a very different story. Without bringing this up tiers, don't forget liabilities. Also can include mortgages and things like that. So more debt doesn't equal credit card debt struggling and things like that. But this just kind of breaks down. By the way, I should add, if anyone wants these charts or any of these charts, let me know. I'm happy to send them to you. But this kind of just breaks down sort of the household wealth. And then this one here is wage growth. And the reason I bring this up is there's a lot of news here. This is where I'm kind of like going to be the slayer of news in a way. I was saying, oh, the average wage growth is dropping, but it's dropping because it spiked up so much in this period of time here post-pandemic. What happened is that everything started opening up, but you still had a lot of people living off of the stimulus and they didn't want to go back to work. So we had incredibly low unemployment numbers, but we had rapidly rising wages. So wages are coming down to more of a historical norm. We're watching this very closely though, because wages need to increase higher than inflation for the economy to continue to grow. This is really important. So if this stays positive, it will be fine. If we start to see negative here, then this could be an issue, and this is a watch point. So again, I'm not trying to say everything is roses and unicorns here. This is a watching point. But when you look at historical, this is not. You had a period of time here, quite a long period of time, when wages were below average and below the growth. And this right here was the single biggest reason. We had a lot of people saying the economy is terrible, even though other data was supporting things otherwise. Again, disregard what was happening here with the pandemic. The last one I'm going to touch upon, household, is just the debt service, because you hear a lot about that too, about household debt levels, rising. Again, you had a period of time with a lot of stimulus, very low debt and debt levels. Some of this, again, due to cost of living, and also some of it is people, spending more and taking on more of that. So household debt service as a percentage of income is important to understand. It's not how much debt you have, it's how much debt you have after income. So again, one thing that this does include is consumer and mortgage debt. Okay, so the difference between the two of them here is this household debt service, and then this here is debt service. So household includes everything. And I just want to bring that up because, again, I'm trying to go through the charts faster. So if this is interesting, send questions over. Unemployment rates, probably not anything new to anybody, is that our numbers are very, very low. We do not have a high unemployment number. The difference between these two numbers I like to explain, because sometimes this data is used interchangeably when there's a narrative out there to say the difference between the U3 and the U5, just trying to get a little closer so you can see the number here, sorry, the U6 and the U3 here, is that this is people that are working less hours than they would like to work. And these are people that are employed. So this one here is people that are working less hours. They would like to work more. They can't work more, or they choose to work less hours. So these are people that are not fully employed by hours worked. Now, sometimes this is not a choice. They have no choice. They're caregiving. They have children, young children. They want to work more, but they can't because of their own personal needs. Other times it's something that the economy, there's not enough jobs. Right, so we watch these two to see when we have really big closeness and when we have really big spreads. The employment picture collectively is pretty good. I'm going to skip past that. I don't think we need this one or this one. I'm sorry, I'm going past some. I don't think we really need this one because I keep hearing about people's concern about where's the hiring happening? How many jobs are being lost to AI, whatnot. And this one, like I said, is a little bit harder maybe to see all the details, but it's showing us where, the historical average, so zero, right? So anything below the zero line is jobs that are losing. We're losing jobs in these sectors. And anything above is where jobs are gaining. So as you can see, the highest ones that are hiring like crazy, education and health services, and construction. Okay, so education and health services demand is very high. They've been for quite a while now the highest sectors in hiring. And these are what education, health services, and construction. And then you kind of see it. And then where you're seeing the drop here, no surprise, information technology. And again, you saw very big hiring in this space, but as the advance in technology continues, not just AI gets all the attention, but just technological advancement in general, you usually will see this fluctuate up and down over long periods of time. More people developing new technology, less people needed because the technology is taking jobs. This is something that we're watching over time. The question always is that just because one sector is losing, one's gaining, sometimes people change jobs. I know a number of times throughout my career where an industry has been declining, and then a lot of people move into a different industry as that industry is growing. So people can sometimes transition and do transition between these. But this is a really good thing just to see where's the hiring, where's the stagnation, and where's the growth. Sorry, where's the hiring, where's the stagnation, where's the decline in this one. Almost done here with the charts. No surprise, probably to anyone who's looked at their account recently who's a growth-focused investor, is kind of where the markets are going. And so this will tie into the next question, which is, are we in a bubble? That's the common thing when you see this big growth in the stock market. Now, do understand this is from 1995, so this has periods of time here. It's also showing the dips when we've had the dot-com drop, right? The financial crisis, on all these pullbacks. So that was a low of the financial crisis. And then the growth we've had since then, as well as, other pullbacks that we've had in the markets. So normal volatility, right? Big drops, big drops, big drops. Tariffs and wars and things like that create drops, but the continued growth. The primary thing to bring up about this and why we're not collectively in a bubble is because the companies are actually earning this money. This is not speculation. I'll talk a little bit more about that in a moment because there are some areas that are a little overvalued, and we'll have some resets here during earnings season, but this is not a bubble in the sense of made up money. This is growth, this is investment, this is the shift of money around, and it's a big productivity story. This one I want to just show because I love this chart, so bear with me on this one, but I think it's a good one, and this is what I like to share with people in general. So this really shows what happens. A lot of times people say, wow, should we get out of the market? Because everything's really high right now. Should we get out of the market? And my answer is always this. It depends. Money you need in the short term. And short term is different for everybody because it depends on whether you're working, you're not. There's a lot of factors that goes into what that means short term, which is why you want to talk with a professional who knows your situation. That's very important. Is because getting out of the market is easy, really easy. Getting back in is really hard to do right. Why? You get out, you say, hey, everything's really, really high. I'm kind of worried about the world situation. Let's sell everything. Let's get out. But by the time you feel safe getting in again, it's usually you've missed most of the opportunity. And this has been proven time again. So what I love about this chart is pretty simple. Financial crisis, right? Bottom of the financial crisis. You have one of three decisions you can make here because you're freaking out. I mean, the world is collapsing. Foreclosures, banks failing, scary times. So one, this is assuming you're invested 100% in the S&P 500. So caveat to that. One, stay invested. They never sold. They just took the ride down, lost half their money on paper. Stayed invested. Number two, waited a year. Went into cash, just waited a year just to make sure, that things were going to stabilize and we weren't going to completely collapse. Waited a year. Number three, stayed in cash. This is a really, really important chart, and this is the reason why jumping in and out of the markets rarely work. Adjusting how much money you have in the market makes perfect sense depending on your needs, but does not make sense based on what's happening in the world at any given time. But this is a really big eye-opener of the difference in just same person, three different decision points and what the outcome would have been. Skip past this. Missing the best days of the market very much ties into that as well. Again, the difference you miss fully invested, miss the best day, miss the 3 best days, miss the 20 best days, which is the argument for why staying in is nobody knows when these days are, including me, until after they've happened. So you can look back and see them, but you can't see them going forward. Miss the 30 best days, 40 best days. So that just shows kind of that difference. Bringing it up again because of those questions. Final one. Markets at all-time highs. This is a terrible time to invest. So this chart here quickly will just show how many times the market has been at all-time highs. This is from 1980. Okay, and it just shows the S&P 500, how many times it's been at all-time highs. The little golden line here is the actual market performance during these times. So what happens is that just because we made an all-time high in any of these locations does not mean the market can't go higher over time. Yes, you will have periods of time of loss and decline. This is why short-term money is never in the markets, don't care how well it's doing. But you can also have times where it's, makes perfect. Okay, well, this is a great time. Oh, no, something terrible is happening. Oh, maybe this is a good time to invest. Oh, no, something terrible is happening. Psychologically, getting in is harder than getting out. But this is just an example to show that the market's making all-time highs. This is how many times it did that period. Doesn't mean that it cannot go higher. Okay, and this is what I'm required to show you as the regulatory disclaimers, and we will stop with the charts. Hope that was okay. I went through them quickly because, again, I prefer to be present when I'm talking. But as I said, if you want those charts or want more charts, I want to do a deeper dive, just let me know, and I will do so. So top topics based on questions asked. I'm going to talk a little bit about where we are in the markets right now. We are just beginning earnings season. And as you probably remember me talking, if you heard the last webinar, I said it's going to be a grab bag. You're going to have, the markets have gone up so much, the valuations have gone so high that the expectation that we, the professional, will have of companies is very high. You are not buying stock for how a company did last quarter, which is what they're reporting on. You're buying for what you think they're going to do going forward, right? So a company could have an amazing earnings report and the stock could get hammered because the guidance is good and it's very expensive. You can see it. You can also see other companies that have not that special of an earnings report, but all of a sudden the concerns about that company went away. They answered those questions. I go, great, good price, let's buy. So the earnings reports are a reset because you get facts of what happened last quarter, but oftentimes you will get guidance as well. So the guidance is really important because it kind of tells you how they're doing. And sometimes, again, the guidance, even if it sounds rosy, what we're looking for is, how are you going to make money at this? And so we've been watching very closely on two things: the spending on AI infrastructure for technology companies, be it data centers or internal infrastructure. There's a lot that goes into that, and how quickly they're monetizing it. And the second thing we're looking at is, I say non-tech companies or companies outside that, is how is their productivity increasing through the use of technology. I'm using AI as a very catch-all word because really there's a lot of productivity gains and a lot of technological advancements that have nothing to do with AI that are also driving this. So sometimes I'll use those words a little interchangeably. But what we're seeing is massive productivity gains within companies across sectors. And even within an industry, we're looking at the companies that are doing the best job with this. And there's a lot of reasons for that. Productivity gains, especially when it doesn't involve the layoff of workforce or significant layoff of workforce, is really key to the next level of economic growth. And eventually could also be the key to solving what may be a pretty significant economic event coming to the 2030s. So we watch that closely, see how is this going to play out. And this is going to be a very interesting, anytime we have a big technological advancement throughout history, you will see this happen where you have this initial disruption. And then from that disruption, you'll have this next growth spurt, right? It's a very, very common initial disruption. And you can think about everything going back to the steam engine, going back to electricity. And it's very much the same thing every time. New technology comes out. Some people adapt, some people are afraid. People come out with a story of how this is the greatest thing ever. And other people come out with stories that we're all going to suffer from this, right? I just remember, I think I mentioned this before, just a couple of things. There's a lot of them. Cars were dangerous. They would rip the skin off your face because they go too quickly. Electricity would cause women to miscarry. There was a lot of the fear that comes into it. And you're hearing much of this with AI. And you've heard it throughout, again, all these technological advancements. The reality is usually somewhere in between. Nobody's face got ripped off. Electricity didn't cause miscarriages. But there were other disruptions, right? Think about the lamplighter that went around on the streets and lit the lamp every night. Okay, that person's got to find a new job. With automobiles, think of the person building harnesses for carriages and things like that, or stables of horses that all of a sudden they didn't have as much need for as the technology advanced. So any advancement will be disruptive. The big concern with AI is job losses, and that AI will take over a lot of human jobs. This will happen to some degree. This is a certainty, simply because anytime you have a technological change, jobs are disrupted. The questions going forward are, again, you can only go with history, you don't know the future, is how adaptable people would be doing different jobs. So if the jobs that go away are these entry-level jobs that don't require a lot of skills, those people can more easily position to other jobs. Whereas if it becomes more disruptive, at this point, and probably for the next couple of years, it's primarily going to be a productivity enhancer for existing workforce. And when you hear of layoffs happening, yes, there will be jobs that will no longer be needed, but we don't see it to be immediately this just massive change. It's more of an overtime thing. It's a productivity enhancer more so than a big. However, companies that hired a lot of people based on a need that is no longer there could need to lay off just to right size the workforce. And I don't like these words because it always makes me feel kind of a little cold-hearted, because every job loss is a disruption and it is a real effect on people's lives. It doesn't really matter whether a company is laying off because they were acquired or all of the usual events that happen, or if it's technological advancement. So that is, at this point, it's more of a, but we are watching this to see where it's going to be infected. On the reverse side of that, we're also seeing huge hiring in construction and trades and specific skills, infrastructure, all those areas right now because of the expansion and the growth. It's significant. They cannot hire enough tradespeople, especially tradespeople with HVAC experience, electrical, et cetera, et cetera. So there's a lot of demand out there. It's just shifting where that demand is. Which will bring me over a little bit to a lot of questions about data centers. This seems to be a really hot topic right now. The one thing about data centers that I just want to bring up is there's a whole lot of incorrect information out there about their use of water and energy. The reason for this is, and this is verified by more than one source that I feel comfortable with, a lot of the anti-data center is funded by China. China really, 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 really wants to get ahead of us on the AI, or at least slow us down. And so there's a lot of misinformation that's come out there and it's been funded. And again, this has been tracked to the level I'm comfortable with it. It doesn't mean that you should discount any negative information or any negative viewpoints. The thing that's important is that there's a lot of misinformation, which is a little bit different than information. That being said, just as a little overview, data centers were being built at a pretty good clip well before AI hit the scene. Data centers is not just AI. AI is increasing the demand significantly for data centers. But if you're using a smartphone, if you're doing online banking, if you're using a computer, pretty much all of this, shopping online, all of this is needs for data centers. So data center demand and need was always there and always increasing. And by not using AI, you're not stopping data centers. The demand will continue to be there. It's just increasing. And it is a consideration of water is used for cooling. It's not disappearing, but it's being used for cooling like any other power plant or anything like that. The resources for water, the resources for electricity is going to be an ongoing issue. That's going to be that balance. No different than any other thing. I recall when solar farms were being built out in the desert and it was disrupting wildlife significantly. Wind farms, things like that. Any new, I would say technology, energy sources, things like that are going to have disruptions that have to be looked at. Some states are doing a really good job, at least from my sort of outsider viewpoint. Case in point, Nevada, that's building a lot of data centers, of saying they have requirement on evaporation use and water use and electricity use and how that's managed to control cost increasing to ratepayers, but also the environmental impacts and water use impacts. So there's going to be a balancing point with this, and it's going to be interesting to see how it's going to work out over time. But I want to bring that up because it was this very like, oh, we should invest in them, or oh my gosh, they're horrible. Do keep in mind, and by the way, none of this should be construed as me saying what you should believe or what you should feel is important. I'm just wanted to speak a little bit about things that more to minimize the fear and the concerns that may or may not be valid. But looking at that, but just like anything else, in some areas, in some communities, it's the massive building of affordable housing. I can speak for Santa Cruz County. They're putting up high rises like crazy, right? The intention is affordable housing. We can all question how affordable it really is. But that being said, it has huge environmental impact, it has huge community impact, it has huge pressure on water and infrastructure and the roads and things like that. But the push is to get more housing. So that every decision we make will always have impacts and considerations, and that's something that will be balanced out over time. And potentially by changes in political administrations and potentially also too by what the communities ask for and the voters ask for. So that was hopefully kind of bringing up a little bit about the data center. The final thing is on the jobs thing. The jobs that are most likely to be displaced are ones that don't have human interaction and can easily be done by machinery. Humans, if there's any service industry, anything with is involving humans, will likely still continue to have it. I know, like in my role at Sequoia, I want human interaction and humans doing the work. It can be assisted by AI, certainly can be assisted by any technology, but humans ultimately are going to be, I see more the bridge between the technology and other humans than being replaced entirely. The other questions here, again, tying this into all the questions, investing overall, I'm not allowed to give advice in a general forum like this by regulations. So this is definitely something that you're going to want to speak to us at Sequoia or to your advisors about your individual situation. But the biggest thing I hope the takeaway was with the first part of this is, if appropriate for your situation, we're still in a growth mode. The probability of recession based on data is very mild at this point. We could always have a shock event. It won't be a war in the Middle East for sure. There's always that risk. No one saw COVID coming, right? There's always things that can happen, but this is not a time to be concerned, but do expect increased volatility in the markets. Earnings in a high value market and the election coming up. Elections, especially midterm elections, usually create more ups and downs, and these are not necessarily a reason to run for the hill. However, the big reminder is money you need in the short term, never in the markets. Don't care how well they're doing, because anything could happen anytime and you don't want to have that loss there. The valuation of the companies are high. Also, I said it brings up more volatility, but also brings up there's going to be a lot of winners and losers. There's going to be some companies that are like, oh my gosh, higher, you're undervalued, and there'll be other ones that are overvalued. There are some bubbles of risk, mostly because there's this huge competition with technological advancement to be first, to be faster, to get more market share, move, and that costs a lot of money. So companies are in the early phase of, we got to spend a lot of money because we got to capture this, to build the technology, build the infrastructure to get ahead. But the window of time that we allow companies to spend a lot of money without getting return on that is pretty short right now because of valuations. So you could see a company that will be very successful over time, but maybe just got a bit ahead of themselves, and they're going to get maybe potentially hit in the values in the short term. Does not mean it's a bad investment. It just means it got a little bit of ahead of itself. So I wouldn't say volatility is a reason not to own a company or a bad earnings season. It's more so how they're going to get themselves out of it. So it could take a couple of earnings seasons, which ties into all the questions about, is SpaceX a good investment? From a pure financial standpoint, it's too soon to tell. Again, I'm not allowed to make recommendations or say whether you should invest something in this forum, but I will say that my usual philosophy with IPOs is I like to wait and get a few earnings seasons under just to really see how the company's doing, because when they're private, it's hard to really get a deep sense of it. So I would say give it time, and it has to be appropriate for your time horizon and risk tolerance. Boy, there's a whole bunch of questions about that. So I will go over to the other part. So the second half of the year, growth will continue. It may not, I shouldn't say may not, highly likely won't be as much as the growth has early in the year based on market valuations. The biggest risk factor to the economy now is actually we're getting conflicting data, so it's a little soon to tell, which is inflation is dropping, with the exception of oil and energy, is dropping. So will that continue? It's expected to continue dropping throughout the year, but will probably not get to the Fed's preferred rate. Again, I'm going to take out oil for the purpose of trying to predict what's happening with the war. So if inflation drops, it will leave a little bit of breathing room for the Fed to potentially take action. But I would say probably not anything big this year. And the reason for that is that the inflation, the other aspect of inflation, is we're getting through, of course, the COVID money, is the fact that the massive spending that's taking place right now in the technological advancement is keeping prices higher, and it will continue. And there's not a lot of solutions. We oftentimes like to blame our leadership for inflation, but they often have very little they can do about it, right? Very little that they can do about it at the time, because the solution is slowing the economy down, which no politician wants to do. And so it will have, and you can do it quickly, right? To have it come down over time is natural, but to have it drop immediately is usually an economic concern, more so than that. The big drop that you see, like I said, was more the energy price drop. That was the big drop for today's data point on that. So with that being said, I'm going to watch, oh my gosh, there is a bunch of questions. Okay, so I'm going to try and get all these questions in order with this. I love answering the questions. I actually feel like it's more valuable than me just talking at you because I never know what you find most interesting, with the exception of what you tell me. Um, let's see. Let's see. I'm gonna do the economic and then do the retirement ones here. Are Trump accounts a good idea? Question mark. Okay, so Trump accounts, for those of you that don't know, and forgive me, I do not like anything named after politicians because there's so much divisiveness and so much attachment to all of that that I'm not fond of that. Doesn't matter who's doing it. Didn't care for Obamacare. Don't care for Trump accounts by name, just because again everything's so politicized. But just an idea what these accounts are. They are live now. You can go to the government website and sign up your kids for them. Essentially, it allows you to put money aside. It's almost like, let's call it a kid's IRA. Make it easy. So basically, essentially what it is that you or other family members or other people can put money aside for a child. There's a limit. There's a 5,000 limit, and that's the max that can be put away every year. And then from that account, when the child turns 18, it becomes their money. So it's a great way. And this money grows tax deferred, just like an IRA. Gross tax deferred. Generally, when kids are 18, they don't have a very high tax bracket. So it's money that they can either save for long term for the purchase of a home or something like that, or even tap for the first month's rent and down payment, first month's rent and whatnot to get into a place like that. So it kind of is a potential complement for other savings plans for children. The neat thing about it is that you have all these years of compounding growth. It's a government plan, so it's set up directly through the government. It's invested in U.S. securities and ETFs and allows that growth to happen over time. Whether or not it's a good investment or not depends on a lot of other factors. What I love about them, my favorite thing about them, two things. Number one, it does give kids a head start that's not tied to education or tied to any one specific thing. So it's a great way of just having that savings. Other family can put money in just like a 529. What I really like about them though, and this is more of a societal thing more than maybe individual, is that while there's a limit on how much individuals can put in these accounts or employers, so employers can make this a benefit. Like if you have these accounts set up, we're going to contribute X amount for that's really great for their employees with children. So I think that's a cool way of adding benefits for employers to easily add a benefit without having to set up more accounts and whatnot. This being said, what I really love about it is that under certain circumstances, and it's pretty simple actually, nonprofits or government agencies actually have no cap on funding. So I'm thinking about kids that grew up in households where putting money aside for the kids' future is not financially feasible. Nonprofits that really specialize in giving kids like a head start or giving kids a start in life could fund these accounts. The parents have to open them, but they could fund these accounts in a meaningful way that could really change a family's financial trajectory in the next generation. So that is actually what really captured me the most, is like, wow, this is a really cool way to make a difference for families that just simply putting money aside is not possible, and it can be done from these organizations. So these accounts can be used in a lot of good ways. There are some considerations. I think Katie, our financial planner, she's going to be talking in an upcoming meeting. She's got a whole bunch of considerations with that from a planning perspective, pros and cons. So like any other investment or savings vehicle, do consult with your financial professional. Do look at the pros and cons just to make sure it makes sense for you. But I'm always for any way that people can set money aside for the future of young people, especially given the cost of living and how challenging it is for young people to get started nowadays. Gone are the days when you can work and put yourself through a state college and share a house with 4 other people. That was me. And make a go of it. It's much harder nowadays. And so this could be a really good help for the future. Midterms in the economy, better Democrat or Republican? It's not so much, it really doesn't matter which party gets ahead in the midterms. It matters more, where they are. Because if you think of Democrats and Republicans, right, you've got moderate ones, and then you've got kind of going out slowly into the more, the word extreme may not be the right word here, but further out, right? So you got the socialist side on the left, and then you got the ultra nationalist side on the right. Again, I hope I'm using the right terms. I'm not good at the political stuff, but it really depends. Like the closer you are in the middle, the more that the parties generally work together and try to find solutions and more things that generally get passed and get done. From an economic perspective, it depends. So oftentimes we say gridlock is the best. Nothing gets done, no surprises. The markets don't like surprises. On the other hand, we have a lot of issues that will need to be solved in the upcoming years that are going to require consensus. So the direction of the midterms, from a pure economic standpoint, again, not getting into anyone's preferences or viewpoints or beliefs, from a pure economic standpoint, doesn't really matter whether it's a Democratic sweep, Republican sweep, or a mixed bag. It matters more what laws and what policies passed. So we'll see how that plays out. Only if there was only a big shocker there would there be kind of more market volatility post-election, or if there was a lot of indecisive and undecided elections that could potentially move things. That's always a risk, but those are generally short term. So that ultimately won't really make much difference economically. Let's see. Oh, that's an interesting question. The cost of fraud and the solutions from an economic and social standpoint. I love these because there's not like just some sentence here, and there's a lot of different ways to see it. I'm going to go with probably a lot of the fraud that we've heard of recently, like in some of the social programs and the healthcare programs like hospice and whatnot. I think, yes, definitely, anytime you can reduce or eliminate fraud, that's simply more money that gets to go to the programs directly and where the need is. Again, if you really look at it from a standpoint of, fraud hurts the taxpayers that are paying their hard-earned money into systems. It hurts the people collecting the benefits legally and legitimately who have a need, and it hurts trust, societal trust, I guess would be the other word for that. And I think some of the cases that I've heard of seems that it's just, if we could just use technology and really stay on top of this thing and do better tracking, a lot of this would never get to the point it's gotten to. Things like hospice fraud. How many years do people normally stay on hospice, right? A lot of this stuff could have been caught, but it wasn't being monitored. And the government's perfectly capable of doing this because Social Security is a great example. As soon as a death is recorded, Social Security is notified. And that was put in place because there were people that were collecting, you've heard, I'm sure, the stories for years, not necessarily reporting things. So they just put a system in place. When a death is recorded, Social Security is notified right away. So there could just be, technology allows really great tracking nowadays on just about everything. So a lot of the fraud, I think, would be eliminated by better use of technology or more investment in technology, use of technology by governments and by these organizations. But just for those three factors alone, economically, certainly, I mean, some of these fraud cases that are reported are really high. And the GAO, so the General Accounts Office of the United States government, nonpartisan government department, basically just think of them as the green eye shades of the US government. They estimate that, I don't know if it's all the healthcare or just Medicaid and Medicare. They estimate $100 billion a year in fraud. That's their estimate. That's a lot of money. There's a lot of places that could go to provide better healthcare coverage, better healthcare outcomes. So we definitely, from an economic standpoint, would certainly be good. And it seems like there's some pretty good solutions there for that. Again, not my strong area of expertise, so I just come more from the economic perspective. Let's see here, going to this question here. I'm sorry, I'm going to skip those. Super political. With all respect, I really want to keep this nonpartisan, and if I think there's an economic component, I'll use it. But if not, I will skip past it. But if you ever send me a question, I don't answer it, and you want to talk about it, just let me know. I'm happy to talk with you offline about it. What is the most important thing to do given all the uncertainty? This one depends. This is a very vague question. It depends on your situation. This definitely, you've heard me say this time and time again, it is so incredibly important to work with someone that knows you and your individual situation for guidance. And the reason for this is that I have some great ideas. There's so many amazing strategies that can be done across the board with your real estate, right? With your investments, with your savings. There's so many different ideas, not just investing, there's so many strategies you could do, tax minimization. There are more strategies than I could talk. Even if I listed them out in the hour we have together, I couldn't go cover them all. One would be really good for one person and terrible for another, and vice versa. So there's not a one good thing. It is really your individual situation. And I cannot stress financial planning enough, because it looks at everything and it tells you both what to optimize now and also how it's going to work going forward. So it really helps with that, to see your specific situation laid out in a solid plan, looking at everything. And I'm not just tooting our own horn because we do that at Sequoia. There are other firms that do it. You want an organization, a company that will do it for a flat fee and not a requirement that you have to buy a product or anything like that. And the reason for that is that everybody should be doing different things. You don't want misaligned incentives. Remember that? Remember the Cobra story I told you last time? Misaligned incentives can create suboptimal advice. So it's good to have someone who's just doing the planning, even if they're doing the rest of it, doing the planning, because you can see how it impacts everything else. But that would answer what's the best thing to do. And that will also help a lot when the news media is, a lot of crazy news coming out, or somebody says something to you, you're like, oh, I didn't know about that. Maybe I should be doing that. Kind of helps with just all this inputs that you're getting to be able to make sure that you're doing what's right and best for your family. Also, a plan is flexible, so it adjusts as life unfolds. It can be rerouted, it can be changed, it can be updated, you can run scenarios. So it's not a set in stone, things are going to happen a certain way. I can tell you, for me, I'm 57. I have no idea when I'm going to retire. I love what I do way too much. Like, I can't imagine not working. But I still have a plan. Why do I have a plan? Because I want to know what happens if I do, right? You want to know. Keep working, fine, but know what it looks like if you do. And that helps a lot. Again, you don't get pulled in from just different pieces of information and different sources. See, some questions about refinancing, of two of them here. I think that really ties in a lot with interest rates. And that is also a highly individualized situation as well, depending on everything else that's going on right now. There's pros and cons to doing that. And so that's not really a general question. And nobody knows where rates is. We have a new Fed chair. And he has a philosophy that there's no point to try to project because they don't know. And I actually would agree with him on that one. Sometimes what's happened with the Federal Reserve in many recent years, for many years now, is that they made projections, but they didn't have all the data and they couldn't know. And they were slow to make adjustments. And the big reason we had the huge inflation spike that we had back in 22, where we were over 9%, was because the Fed was slow to react to something that all of us economists knew. This is economics 101. Too much money in the system, everything opens up, we're going to have inflation. It was like basic math, right? Basic economics. But the Fed missed it and they were slow. And that's why they still had to move so aggressively and they were kind of behind the curve. And that's why we had that spike. I'm not going to blame it solely on the Fed because, again, the government spending was the fuel for the fire. But they were using, so the new Fed chair is working very hard. He's created these working committees within the Fed to try to look at how do they analyze data and could they be doing it differently. And I'd be very interested to see what they come up with in that. But one thing he does is he does not try to project. And it's good because imagine if you had tried to project the beginning of the year before you knew there was going to be a war, right? There's constantly information changing. So they're more reacting to what's happening on the ground and making their best choices. On the Fed side, unemployment is lower than they need it to be. So they don't have to worry about employment and stimulating the economy. What they more have to worry about is controlling inflation and not having it run away. So that's the idea. So if I had to guess, not a prediction, I would say they're going to be loath to doing a lot of interest rate cuts, if any, this year, just because they're going to want to see inflation continue to moderate. How the conflict happens and what happens to inflation may speed up. Maybe they will be able to do a cut this year. But at this point, like I said, I wouldn't be able to base a real estate decision, which has so many other components, on that. Can I transfer my home to my kids? I don't live in it anymore. Wow, there are so many tax and planning considerations with that you're going to really, really, really want to understand before you do it. I do not know who this person is. So this one is one you're definitely going to want to consult with a professional on. And with all respect to real estate agents and mortgage professionals, you're going to want to get an opinion with someone not involved in the transaction as well, just to be sure if you're transferring debt to the kids or anything like that. There's a big tax component with if you're in California with Prop 19, Prop 20, and those changes have happened. You're definitely going to want to consult with professionals to understand there are some really big tax and financial considerations. And there's some other ways to do it if that's your intention, to make sure they get the home. There's a lot of ways to plan around that, but definitely speak with a professional to make sure that what your intention is, what your wishes are, is what's going to be met, and you're unaware of any potential risks to it. Okay, more bubble questions. So skip past that one. Okay, going into more questions. Bear with me here. Okay. Okay, if the economy crashes hard at the end of the year, what should we have done now? If you believe very strongly in the core of yourself that the economy is going to crash, you do have a choice to pay down debt aggressively, right? Because, and again, I don't know this person. I don't know if you're working, if you're living off your savings and whatnot. If you're working, let's say even the Kaizen crowd, let's say you're afraid you're going to lose your job, you're afraid there's going to be a big economic event, whatever that is. This is very general, again, not individualized advice. Pay down debt or make sure your debt's manageable with the savings that you have. That's the first thing you can do. Pay down debt, especially non-mortgage debt, right? So auto loan debt, credit card debt, pay down debt, because that will mean less outflow will be needed, money needed to pay to bills every month. Pay what you can. Whether it's an economic drop, crash, or a loss of a job, that is the single biggest thing you can do. Have enough savings and pay down debt. How much, you don't want to pull too much out of savings to pay down debt because you're going to need liquidity, but you also want to see if you can manage what those costs are. If again, it's concerns of markets, you have two considerations. If you're invested in stocks, let's just keep it simple here and say it's in a retirement account or it's not in a retirement account. In a retirement account, you don't have to worry about taxes to sell. In a non-retirement account, you do. So do be mindful that getting out of the market in a non-retirement account will have could well have tax consequences, and you want to be prepared for that, because if next year is not doing well and you have to pay the tax man, that could also be a challenge as well. So you could say that. And the other issue is if you're going to get out, but you still have a long time horizon, have a very, very, very defined what will put me back in. What will put me back in. And it has to be very defined by data, not by I like the president, I don't like the president, or this or that, or the governor, or whomever. I mean, it can't be subjective things, it has to be objective, because you need to have some very strong discipline around it. No one, including myself, knows if a sudden shock event will happen. The probability of recession is always based on data. Not counting the very, very short and weird recession early in the pandemic and the technical recession in 22 with the spike in rates and the crash in the markets. The last significant recession, the financial crisis, there was plenty of warning. The economy was deteriorating the summer before the crash. It really started deteriorating in the fall. And so there was in the summer was too soon. It was like, oh, keep an eye on this. By the fall, it's like, no, this isn't looking good. By the spring, by the winter, spring, it was clear that we were going to head to a recession or a downturn. That was by data. No idea we're going to have a full-on financial crisis, but certainly we're heading to recession, and that's when the action's taken. The data supports it. Retrospect, it would have, if I know the whole thing was going to crash, but you can tell by data, but it takes time for that data to play out. We've had flashing signs here and there, and then they've gone away. So you can have disturbances within there, but truly nobody really knows. It's just probabilities of success. So to this individual, I would say, talk to your financial professionals who know you and know your situation and understand the pros and cons to that. Another thing though, caveat to that, is not everybody needs to invest. So if you're really uncomfortable with the state of the world, with volatility, with anything like that, talk to your professionals and say, is there a way I can do this with less risk? Can I still achieve my goals with less risk? Because there is sometimes this idea that everybody has to put their money in the stock market, and that's not really always the case. So just understand what those trade-offs are going to be if that comes up. So, okay, I'm grabbing the other questions here. Okay. What sectors are hot? And this was what they used right now. Well, we can all speak to technology, right? Technology is doing very well. A lot of that, again, is it's not a dot-com bubble because, again, money's being earned there. But the ability to monetize is still, we're early on. So there are some areas that are actually more in the infrastructure space. They're still doing very well. A lot of, and you may have heard this story before. I've mentioned it before. It's not an uncommon saying. I like investing in what I call the picks and axes rather than necessarily the outright company. Okay, so most of the AI companies, direct AI companies, are not public yet. But you look at it, the infrastructure is diversified. It's not just related to AI. And that's needed by everybody. Okay, so the picks and axes saying comes back from the gold rush. Okay, when the gold miners were rushing to California, rushing to the West to mine for gold and silver. Many of them didn't make any money and never discovered meaningful amounts of gold. But the people who did make money were all the people selling picks and axes and mining gear and the things needed for them to go out and prospect for gold. So the same thing here now is the infrastructure is at high, hot demand right now. They cannot build medical facilities fast enough, especially given since Obamacare, the massive amount of money that the government is putting into healthcare. And despite the news headlines, it has not meaningfully changed. So the government is funding most healthcare. So you're seeing hospitals expand and build and grow, and medical practice, the corporate medical practice expand and grow. You can just see that. So there's just this infrastructure there, affordable housing push, I shouldn't just say affordable, housing pushes that they can't build enough houses fast enough, right? So the infrastructure is just growing and growing, and this will continue as the demand is there. So when you have that, whether it's a data center or a hospital or an apartment building, right? It's still growth, and it's still infrastructure. Also, the technology around that, the materials around that, and things like that. That's an example, because that will likely continue for a while because there's a lot of things pushing towards it. Other areas outside of the technology space that has been good is even resources. The demand for resources is very, very, very high, and this is on a global scale. It doesn't just have to be in the US. There's a lot of opportunities overseas as well. So again, there's not really a hot sector per se, right? I like the term hot. That was their term, not mine. The sectors in more diversification matters more, because if you have diversification, yes, it may not shoot up as fast as this, but it helps smooth the ride when things get volatile. Because it takes just one event to happen, as we saw early this year, not about the war, but about the fear around what would happen to software companies, right? AI is going to take over, that we don't need software anymore. And all the software stocks just tanked, which to me, I was kind of laughing. I'm like, no, most people are not going to be out there programming their own agents or building their own agents. Like, they're going to be using software that's connected to AI. It was completely overblown, nice, juicy buying opportunity, but that was more because bunch of headline news came out and the market reacted to it. So sometimes the best sector to invest in is one that just is not in favor for reasons that don't make a lot of sense. With that one, see if I think these other two I covered. So with that being said, unless there's any other questions that come in, I'll give you updates on future webinars and then the last part. So I said Bob Stein, October 6th on our webinar then. You've heard him before if you listen to our webinars. He's the Washington Economist, and he's going to be talking about midterms and politics and all of that stuff for those that really like that. The political aspect of it, he does it in a nonpartisan way. He's just kind of really telling probabilities, what the different mixes could look like. And that will give you close enough to the election. It'll probably be reasonably interesting in where we are on that day. We also will have, still trying to get the date, trying to get their schedule and our schedule working, but ARK Investing, Kathy Woods, that team, for those of you who love innovation, I'd love to know what's the next big thing, what's coming down the pike. We'll have the ARK team, Kathy Woods team, come out and talk about innovation. It's been a really popular one, just trying to coordinate that one. Also coming in months, we'll have Katie be talking about planning considerations for 2026, things to think about, things to share with other people, because, I said that part is awareness is power, and I'll also be keeping you up on the economy. And the last question, I actually saved this for last intentionally, so I'll be quick. That was, the question I get, it was given to me in this form, but I've also get it from people often is, kind of what keeps me awake at night. They say that, whatever's happening, you seem to have a generally optimistic attitude and whatnot. And so what's the thing that keeps you awake at night? And nothing economically keeps me awake at night, because you can adapt to anything. You just have to know what to do and how to adapt. The economy is like the seasons, right? You do different things in the winter, different things in the summer, different things in the spring. It's just the way it is, right? You adapt to the change in the climate, and they're different with the economy. So that in itself, I've been doing this long enough. I'm very comfortable with that journey. The thing that I think that would keep me awake the most at night, or I don't want to say not even that just stresses me most of the night, is the fear and concerns that a lot of clients hold or individuals hold in my life just about the state of the world. Regardless of their political or social leanings or anything else, it's just that fear that can sometimes really just kind of capture people. And so that's the thing, because I hold people in my heart, and it's hard for me to see people, struggling and being in fear and being worried. And, I say, well, don't watch the news. I'll pay attention for you. Go outside and pet your dog. But it's hard to be really practical about that, right? I mean, we do have exposure to news 24/7, and a lot of people are really worried and stressed for a lot of different reasons. Most of it, like I said, things happening outside. So my solution for that, and the reason I think I don't stress, is I kind of think of my inner space, my inner world, for lack of a better term, like a garden. And I am very diligent about weeding my garden. So when there's a lot of negativity out there, there's a lot of things like that out in the world, I just pick those weeds fast. They don't serve me. There's no need to ruminate on them. It takes away from the joy of the plants that I want to grow, which is my caring for my communities, the caring for my clients, my love of nature, the love of my animals, my husband, my family. I want space to be with them. So I pluck those weeds out really quick. And I think that's a lot of ways. It's always, what am I focused on? What is my intention here? And what am I here to do to be in service to others? So that maybe, again, I'm not always good at explaining these things, but that's the big thing to me is the only thing that keeps me awake at night is truly my clients, the people I know, my community, my friends, my family, and making sure everyone's taken care of. I'm a fierce protector. That's kind of the nature of who I am, and I just want everybody to be okay. And I can take care of the money, but the other stuff, I just don't like to see people stressed out. So I bring this up because anytime something's disturbing you out there in the world, anytime you have fear about, it doesn't just be about the economy, anything, just reach out to me. We'll schedule a time, we'll talk it through, we'll decide if there's a different pathway, but don't allow everything happening in the world to eat you inside. Save that space for those that you care for. I guess that would be, my closing thought and the answer to that question. And again, like always, please let me know if there's something you want to hear more about, less about. I continue to adapt this to based on the people who tell me the most things. But this is for you. This time is for you to be able to give you the information that's most valuable. And you can always send things to me in advance, and you can always reach out to me individually as well. So they're happy to help and share information. So with that being said, I will let you all get on with the rest of your day or whatever time you're listening to this recording. And as always, thank you very much for your trust and confidence in us. And thank you for listening to this webinar. I'll say bye for now.